Hello guys, this is Universalis FX. In this video, we are going to be doing a comprehensive study on order blocks. In the previous class, we actually looked at a brief study on market structure and order blocks, and we talked about the three types of market structure: the bullish market structure, the bearish market structure, and the range market structure. We talked about the bullish market structure as a market structure that make a series of higher highs and higher lows, and a bearish market structure as market structure that makes series of lower highs and lower lows. And we also talked about the range market, the market without direction. It neither moves up or down. The bullish market structure moves up, the bearish market structure moves down. And we also did a brief study on order block. We talked about the two types of order blocks: the bullish order blocks and the bearish order block. But in this video, we are going to go in depth on the study of order blocks. Let us go to what we have here. I already marked out something here. Okay, we're going to be looking at the two types of order blocks we have: the bullish order blocks and the bearish order blocks. And I'm also going to be showing you the kind of order blocks I personally trust: high probability order blocks. That's what I call them. I call them high probability order blocks. And now there are actually three criteria for high probability order block. One of them is liquidity grab or stop hunt. The second one is break in market structure, BMS. Anywhere you see me use this term LG, it means liquidity grab. Anywhere you see me use stop hunt, that is SH, it means stop hunt. Anywhere you see me use BMS, it means break in market structure. And the third one is spontaneous move or impulsive move. Now, for me to term an order block a high probability order block, it should have these three criteria. But this number one is not exactly compulsory. But these two, break in market structure and spontaneous or impulsive move, those two are very, very important for me to consider an order block a high probability order block. Now, I don't mean that other order blocks may not work. Yes, they might work, but these are the three things I look at when trading high probability order blocks, when trading order block personally. Let us go to what we have on the right. First, we're going to be talking about bullish order blocks. Like I said previously, in the previous video, bullish order blocks are actually bearish candlesticks before an upward move in price that price later comes to test later in the future, then reject from that zone. Now, let me just tell you a little behind the scene of order blocks. Let me just let you know what goes on behind the scene on order blocks. Order blocks are actually pool of orders by central banks or market makers. The central banks are actually the market makers. They actually inject their funds in order blocks, and when they do that, they make price move impulsively. Then they come back to that zone, retest that part where they injected their funds, and price gets a kind of rejection from that zone. I don't know if you are getting me. I'm going to repeat myself again. Order blocks are actually pool of orders. It's actually a kind of footprint telling you that market makers are involved in the market. It signifies where they have injected their funds. Market makers are actually the central banks, where they inject funds and price move impulsively away from where they have injected funds, towards the direction they have injected funds. They come back to test the zone or mitigate the zone and then move away from that zone. That's what actually happens behind the scene. So, in the case of a bullish order block are bearish candlesticks. They inject fund, price move impulsively, breaks market structure, then price later comes back to retest the zone, and that is where we look for trade. As price comes to retest the zone, we look for trading opportunities here, or you can actually put a pending order there in the zone and expect price to reject from there. That's how trades are being taken off order blocks, in this case bullish order blocks. Now I want you to understand something. For the three criteria I look for while trading high probability order blocks, I told you initially that I look for three things: liquidity grab or stop hunt. Now I'm going to explain what that means. Liquidity grab or stop hunt mean where price actually challenges a previous structure. Like when price takes out liquidity or money from a previous structural low or structural high. When price does that, when they stomp hunt or take out liquidity from a previous low or high or a previous pool of liquidity, they gain momentum to move in another direction. Now, in this case, I look at liquidity grab or stop hunt. Then the next thing I look for is break in market structure. You can see that this market structure was broken here. You get, this market structure was broken here, and price came back to retest the order block and gain bullish momentum to continue to the upside. That is that about bullish order block. Now for bearish order blocks are bullish candlesticks responsible for price move down. Now they are bullish candlesticks. Price moves impulsively or spontaneously away from it. I look for what? Liquidity grab first. Then an order block is being formed. When price is moving upward, we see series of bullish candles. The last bullish candle that takes out liquidity, or the last bullish candle before the downward move that breaks market structure, should be regarded as the order block. The last bearish candle before the upward move that broke market structure is what I consider a bullish order block in this case. The last bullish candle before the downward move, spontaneous downward move that broke market structure, is what I consider a bearish order block in this case. Now let me continue what I was saying about bearish order block. First, for high probability order blocks, I look for liquidity grab or stop hunt, where price has taken liquidity above, the liquidity resting above here, then price move impulsively. The order block must be present there first. Price moves impulsively or spontaneously to break market structure. After the spontaneous move, price came back to retest the bearish order block and continue the move downwards. That is that about bearish order blocks. Now we are going to be going over to the live chart and actually observe how it plays out on the live chart. There's something I want to state here. I expect you to actually observe the behavior and not the pattern. Keep the pattern at the back of your mind. The pattern, keep it at the back of your mind. But it is the behavior I want you to understand. Now, what behavior am I talking about? I expect you to watch out for some specific behavior. One, there must be liquidity grab, which is not exactly compulsory. An order block is being created and there should be an impulsive move away from price that breaks market structure. This low here was broken here, broke market structure, retested here, the bearish order block, then moved away from there. And this is where we are looking for trade entries. Then stop loss can be placed above the high. In this case, we look for stomp hunt or liquidity grab, order block created, an impulsive move away that broke market structure. We look forward to a retest of that zone, that is the zone of the bullish order block, then look forward for price to pull out from that zone. This zone is where we take our trade entry for a buy. This zone is where we take our trade entry for a sell. I hope that is clear enough for you guys. I'll moving on to the live chat now. I think there are some. Okay, yeah. I already have some things marked out here. Yeah, like I said previously, or like I explained on the Paint software that is on that markup there. I said there are things I look out for. First, I would like us to deal with bearish order blocks first. There are things I look out for. The first thing I look out for is what? Liquidity grab or stop hunt. Now you can see that these highs are relatively equal. What is resting above the liquidity? Money. This is actually where money resides. So what I actually expect is for markets to break this zone, take out liquidity out of the highs of this spot. Now let me explain why liquidity usually rests on spots like this. I think that is actually going to make you all understand why I actually target zones like this and expect them to actually be taken out later. Now, when retail traders um, actually view these spots as um, resistance, so what they actually do is when they want to trade lower, like in this scenario, let me insert shapes rectangle. Let me insert this. Okay, for retail traders, they view this high as resistance and view this low as support. Now what retail traders do is, once price has created a high, they mark out that zone as resistance, so that if price comes up there to retest that zone, they are going to take a trade from the resistance and put their stop loss above the resistance or at the resistance and trade lower to support. So let us say a retail trader has actually taken, when I say retail trader, we actually trade using institutional concepts. We trade following market maker pattern. We don't trade the retail way. Retail way, they trade support and resistance. You've never heard about me talking about support and resistance in any of my videos, because that's not what we're all about. We follow institutional concepts, smart money concepts. That's what we're all about here. So in this case, when market has created a high and a low, they view the high as support and they view the low as resistance. So in this first case, market gave them what they needed. It created a high. Now, second time price came up here and rejected. To them, this is going to become a high probability resistance zone. They would expect for price to come back there later in the future and reject from there, and they will trade from that resistance zone from here. down back to support, making profit. That's the way they view things. But now, market makers, they do contrary to that. We see that high as pool of liquidity because that is where their stop loss will be and their take profit will be here. So they expected to take a trade from here. When price comes back here, trading back into support. But here price broke it. That is hitting their stop loss, taking away their money, and pulling down backward eventually. Now imagine the stop loss of those retail traders. It is going to be a hit off. That is what market makers do. Money resides above relative equal highs and money resides below relative equal lows. That is why I actually look for them as targets when trading. Now, the first thing I look out for is liquidity grab or stop point. Yeah, there is something else I want to point out here. Retail traders also, they trade breakouts. Now, and when the idea of trading breakout is actually when market breaks out from a particular zone or from a particular structure. Let us say market breaks out from a resistance, a particular area of resistance. What they actually look out for is for price to move up, retest, come back into the resistance sort of, then pull up and keep on moving higher and higher and higher. But in this case, the market makers do contrary to that. There are two sets of retail traders that actually attack in this scenario. In the first case, it is actually retail traders that are trying to sell off this resistance zone when price comes to retest the third time. This resistance zone, they expect price to reject from there. They put their stop loss above here and also buy stops of retail traders. Retail traders place buy stops above here so that when price breaks out, their buy stops get activated and they keep on trending and riding the trend higher and higher and higher. But in this case, the two of them will be burnt because the stop loss of retail traders that would have taken the sell from this resistance and buy stops of breakout traders that would have gotten their buy stops activated here. Price actually made an impulsive bullish move here, taking out liquidity, but in the mind of the retail trader, they will think it's actually a breakout to keep on riding the buy upward. That is the buy trend upwards and upward and upward. But in this case, price took out liquidities, activated the buy stops of breakout traders, and then rejected, keeping both of them in loss. Because when breakout traders actually trade breakout, they put their stop loss below the resistance area so that when price keeps on moving up, activate their order above the resistance. They keep their limit order, their stop loss below. See what price does. It took out liquidity, took out liquidity of resistance trader, the sells they might have taken, activated the buy stops of breakout traders, and later came back to hit their stop loss, which would have been placed below here. I hope that is clear. So trading in following smart money concept is actually the best way. Any retail idea you have in the past, you can just keep them at the back of your mind and actually focus now on what I'm trying to teach you, because this is actually everything you need to know to actually be better in the market and to actually progress faster. If you keep on using retail methods, I promise you you would make little or no progress. You would make little or no progress. Yeah, I admit that there are people making money using retail way, but I promise you that trading using the smart money concept is actually more profitable, is actually more consistent, and is actually easier to understand. Okay, so it's actually easier to understand, I would say that, but not simple. It is easy to understand but not simple, I would not I would have to say that here. So in this case, liquidity grab or stop hunt first, then we expect an impulsive move. You can see an impulsive move away after liquidity grab, impulsive move after the order block. In this particular case, this order block was engulfed. Okay, there was an impulsive move. There was liquidity grab first, impulsive move that broke market structure. See this relative equal lows. The same thing that happened to them up here would have happened to them down here, because this is actually viewed as support. So when price comes here, they expect price to bounce off from here and move up. They expect price to bounce off from here, their support, and move up. But market makers hit their stop loss. Breakout traders will be activated, their buy stops will be activated. Then immediately the stop loss of buy stop of breakup traders who place their sell stops below here, the sell stops of breakout traders that actually took the breakout trade here, their stop loss will be hit as this candle move up, because usually they place their stop loss at this point or just a little bit here above support. Retail traders actually do two things here. I'm going to state it again. Just like in this case, retail traders expect price for the third time because they have seen consistency. Support, they expect this support line to actually be a strong line of support. So that when price tests there the third time, they expect price to move up from there, because it has happened 2 times in the past. But now, price actually didn't do that. Price broke the support. Their stop loss will be below here. That means money is actually lying below the zone. Market maker takes the stop loss, activates the sell stop of sellers, breakout traders, because they expect if price break out of this zone, price is supposed to be moving lower and lower and lower and lower. But no, price didn't do that. Price came back up after taking out the stop loss of people that took buys from the support, and also activate the orders of breakout traders that place sell stops for price to keep on moving down. But price took out the stop loss of such traders too, came into our zone and tested the bearish order block. It went into the zone of the bearish order block, and you can see the move away from that zone. And if you notice what happened, price kept on moving down and down and down and down and down. Now imagine taking a trade from this particular zone, and let us measure something. Your stop loss will be very few. Okay, this is I think 23 pips stop loss. Later we're going to talk about refinements, how you can minimize your stop loss so that you will not be exposed to much risk. Now our stop loss will be actually above the high from the zone of the order block, from where we are taking our trade. Let us say the stop loss will be 21. You can actually see 219 there, but 21 is actually the stop loss. I'm going to explain stop loss and TP placement later. Now 21 is your stop loss. That means if you are risking $21, you are risking $21 to actually get, let us see how far this market went. $21 from where we have taken our trade here, risking $21 to get how much? $21 to get approximately $395. That's actually a very, very big risk to reward ratio. risking $21 to get $395 is actually a very very big one. Now I'm going to actually teach you how to actually trade what's it called take sniper entries, though you don't always look out for that. There are actually ways to refine the trades to actually get close to taking the trade at this level so that you can actually minimize your loss and actually partake from this big move down. Yeah, I'm going to talk about the idea again. First, this is actually to make you guys understand. I'm actually going to do everything I can to make you guys understand. First, what I expect is liquidity grab or stop hunt. I expect an impulsive or spontaneous move. When I mean impulsive or spontaneous move, I mean after price has done liquidity grab or stop hunt, I expect price to reject from that zone or move from that zone spontaneously or impulsively. When I mean impulsively or spontaneously, I actually mean a kind of fast move after it has taken, because we don't the idea is that market makers don't want retail traders to kind of recover or close early, so they turn back against them fast. And when they inject their fund in that other block, like I told you previously, their funds actually causes injecting their funds into the market. Central banks, when they inject their fund into the marketplace, it actually creates a big move, a big move or fast move. Now when I see something like that, it tells me that the other block here is actually created by the institutional bodies, is actually created by market makers, is actually created by central banks. When I notice that kind of thing, I know that this other block is actually going to be high probability. Now we see break in market structure. Market broke these previous lows, broke below, came back to retest the zone, and price came to test. Now for profit taking, the first low is supposed to be your first take profit. Now we expect price to first, after retest, the first low is supposed to be your first take profit. This is where you're going to take your first profit. Then, or you can take your partials here. Then you can keep on riding downward and downward and downward, and price kept on moving down and down and down and down. And that's all about bearish order blocks. That's all about bearish order blocks. You can see in this case too, um in this case too, a bearish order block, a bearish order block, price went down, came back to retest the bearish order block, and price kept on going down, taking this low, and it continues like that. This again, the bullish candle before the downward move that broke market structure, price came to test in the other block, price came to test this other block and kept on going down and down and down. That's just the entire idea about bearish order block. Now that's, we used Euro USD 4-hour time frame to actually explain and notate for the bearish order block, and we are going to be making use of dollar index, US dollar index, to explain for the bullish scenario. Yeah, just like we have it in Euro USD, in this case we have the same thing here. We have liquidity grab, we have an impulsive move away from that zone, from liquidity grab, from that spot. After another block is created, we expect an impulsive move away from it that broke market structure. You have to see market structure broken, then price comes back to retest the bullish order block. The bullish order block, always remember, even though it is called a bullish order block, it is actually a bearish candlestick before an impulsive move that breaks market structure, that price comes to retest and gains momentum to move to the upside, taking out liquidity from every low, from every recent highs. Sorry, in this case, because we're talking about a bullish order block. So that's how that's the entire idea about order blocks. Everything I explained about bearish order blocks also plays out here, because in this case, um, retail traders are actually going to see here as support. Price came to retest there. They would have actually thought price came here to retest zone, took out their they would have actually seen here as this kind of support area. Price comes back here to hit them off with this wick here. You can see that there's a liquidity grab. Now there's something I want to tell you about liquidity grab. For a liquidity grab, I want to see price taking out relative equal highs or relative equal lows with either a candlestick or two. But the best I actually want to see is price taking um, equal highs or equal lows with a candlestick or two. Okay, but most especially I actually prefer a week. Let me make use of this. For example, these highs here, they're relatively equal. Like all these highs here, this high, this high, this high, this high, they're relatively equal. Now I actually want to see price take it by a week, take out liquidity by a week or two, then continue its move downward like that. And also, like, okay, this, I actually view this as a liquidity pool. You understand? Relative equal highs and relative equal lows are actually viewed as liquidity pools, and I expect price or market makers to actually come to hunt those areas and take out liquidity from those zones and reject. Now, in this case, liquidity, there was liquidity grab. The relative equal lows was taking. There was an impulsive move, but in this case, price didn't test the bullish order block. Now there are actually reasons for that. All those things are actually going to be explained later on. There are actually times where order blocks fail. I'm going to explain that. Now, in fact, I'm going to give you a hint here. The reason why sometimes order blocks fail, especially in lower time frame, is because market makers are not done on the higher time frame. If the market maker trend on the higher time frame is still bearish, bullish order blocks would hardly hold on lower time frames. I will repeat that again. If the market maker trend on higher time frames, let us say daily, is still bearish, bullish order blocks hardly holds on lower time frame. This is 4-hour time frame, so normally you would expect for price to actually come back to this particular order block, come back to this particular bullish order block and test it. You expect price, because there was liquidity grab, impulsive move, you expect price to come and test that zone and move up. But on the higher time frame, the market maker trend is still trending downwards, so we would not expect this to be respected. We would not expect this to be respected. Now, nothing in trading is 100%. That's one thing I want you to know. It's actually a game of probability. But what I want you to understand is that if you take a trade um, and actually win over 50% of the time, that is above average, you're actually good in this market. That's just all I have to say. So, concerning this, like I said previously, I expect liquidity grab to actually be by one candle or by two maximum. I actually prefer weeks, liquidity grabs to be taken by weeks. Mostly when I mean week, I actually mean this tiny thing here above candles, all those candles, the tiny line. Those are what we call wicks. Wicks are actually what's it called, identifying the presence of the market, where the market has actually reached out before actually coming down later. You understand? So that's just that about liquidity grab or stop hunt. They hunt for relative equal lows or relative equal highs, because that is actually kind of levels where retail traders actually place their stop losses and above, for breakout traders, that is actually above that or below those zones. That's actually where they place their buy stops or sell stops. And that is that about. And you can see after what's it called, liquidity grab was taken here, there was break in market structure after a spontaneous or impulsive move. Take note of that. Now I mentioned three um, criteria for high probability trade. One of them is liquidity grab, second is break in market structure, and the third one is spontaneous move, or you can also call it impulsive move. What I mean by spontaneous or impulsive move is a kind of fast move before breaking market structure and after the other block. Now, after the other block, there must be an impulsive move. Then, before breaking market structure, there should be an impulsive move that actually breaks the market structure before the retest to the other block and price keeps on moving. Now, there's something I want you all to understand. Liquidity grab is not compulsory. Liquidity grab is not compulsory. There's a reason I start these two. These two are actually the most important things I look out for: break in market structure and spontaneous or fast move. Break in market structure and spontaneous and impulsive move. That means the two things I actually want to see, even though there is no liquidity grab, the two things I actually want to see is spontaneous move, that is fast move that breaks market structure, and BMS, breaking market structure itself. Once market structure is broken and once there's a fast and impulsive move, I view the other block before all these things a high probability other block. And that's that about other blocks. The bullish scenario here, you can see after price retested the zone, price kept on moving higher and higher and higher and higher and higher. The stop loss will be actually below here, and you can see how far price moved. First target will be above here, and price did that. Price actually hit first target, gave a retest to a particular order block around here. Price came here, retested this other block, and that pushed price higher and higher and higher and higher. So that's that about order blocks. That will be all for today, guys. In the next video I'm going to be doing a kind of, really, I don't know, I actually don't know what the next video is going to be about. It's going to be about what you guys actually want, but what I actually have in mind is top-down analysis, where I'll actually show you how to actually move from higher time frames, go down into lower time frames, and how I actually look for trading ideas, trading opportunities, how I refine my entries. If that is something you guys will be wanting to look out for, you can let me know after you've seen this video, and I'm going to be doing a video on top-down analysis, how I actually do my analysis, my technical analysis from the higher time frame down to the lower time frame. You're going to be learning about trade refinement. That is how I minimize my stop loss, how I don't expose myself to much risk, how I actually take sniper entries, even though I don't want to expose that here, but I'm going to actually like give you guys clue about that, because that is actually going to be reserved for the advanced mentorship. This is actually for basic mentorship. I actually want to teach you guys a lot here, and if you pay attention, I promise you all, you are going to actually make money. You're actually going to be consistent, and you're actually going to make good analysis if you actually follow what I have taught you. This is where I'm going to be ending it. Thanks for watching, and God bless you.